If you think about Bitcoin's price, since really the ETF launched, it's gone in two phases. It went from 50 to 72, and then it treaded water for 6 months. And then it went from 72 to 100, and it basically has treaded water since then. The reason it stopped at 72 is that people are people, and that was the previous all-time high, and you had to work through people who were willing to sell there. The reason it stopped at 100 is people are people, and some people are willing to sell at 100, right? Like the two sleeping stop loss orders on River are 100 and a million, right? That's just like, because people are normal people. I bring all that up because I think this demand is just chewing through the number of people who are willing to sell at $100,000. And if I'm right and it persists, it will eventually exhaust them. And I think in the next 6 to 12 months, it'll move up to the next place people are willing to sell. If you think about what's happened to Bitcoin over the last 18 months, there's really been two big changes. One, it's become significantly easier for traditional investors to access it with the advent of ETFs and some of the regulatory improvements. It's been de-risked. And at the same time, the urgency of accessing it has increased with sort of rising debts and deficits and concerns about fiat debasement and people wanting broad-based exposure. The reason I'm calling it the summer of accumulation is behind the scenes every day. What Bitwise does is it talks to these large institutional investors and large wealth management platforms, people who control hundreds of billions and trillions of dollars. And no joke, every week, a new one of these platforms turns on exposure to Bitcoin. They let people invest in it for the first time ever. Really, almost every week, we could say another $1 trillion opens up to Bitcoin. We're going through this one-time phase where institutional investors are moving into the Bitcoin space. And there's, trillions of dollars of money that needs exposure to Bitcoin. We have this vanishing window to get in ahead of those trillions of dollars of institutional capital. And I just think you have to make use of this summer. Every time the Bitcoin ticks sideways, I think of it as a little gift to me, more time to accumulate sats, more time to build the Bitcoin position before the largest money in the world comes in. This is a one-time deal. It'll happen. The price will go higher, in my view, significantly higher, and then we'll be at a new normal. So this is like the end of the window where you can get in ahead of institutions, and it's changing really, really fast.
I would love for you to touch on the Mohammed Al-Arian thing we were talking about offline and just kind of this rotation we're seeing right now. I would love for you to touch on that.
Yeah, it's absolutely amazing. I mean, he wrote an article in the Financial Times. He tweeted about it, how in these recent crises that have hit the world, people have not rotated into treasuries as a safe haven asset. For the last 40 years, when there was a macro crisis or a geopolitical crisis or some shake in the financial market, the first thing traders did, the first thing institutions did, was to buy US treasuries. They were the safe haven store of value. And so you would see yields drop and liquidity increase. And Mohammed Al-Arian, obviously one of the most important investors in the world, ex-PIMCO, part of Allianz, a global force, not a Bitcoin degen, noted that we're not seeing that at all, right? During these recent macro crises, the yields don't move on treasuries and the volume doesn't increase. Instead, where the money goes is first into gold and then within a day or two into Bitcoin, right? In other words, the world's safe haven asset is shifting from treasuries to hard assets like gold and Bitcoin. And that's just an enormous change. I mean, that's a sea change, 40 years of treasuries being the safe haven asset. We're not making this up. It's looking at the data. The data is showing investors no longer treat that as such. Treasuries are something else. The safe haven asset, the asset you rotate into, is gold and Bitcoin. And that's like a canary in the coal mine in terms of how portfolios are going to orient themselves. They're all going to have exposure to these hard assets, these stores of value, because they're the biggest hedge against, sort of the really destabilizing risks in the world. It's just really notable to me that that's happening right in front of your eyes. I think if you've looked throughout this year, there have been moments where the stock market has fallen during the tariff tantrum, for instance, and Bitcoin has diverged. In fact, this is actually, that was actually the first macro shock in Bitcoin's history, really, where it had an inverse correlation with stocks. And I think what separates this macro shock from the past or the tariff macro shock, it was the first time that there were ETFs It was the first time that there were options on Bitcoin. So it was the first time it was easy for traditional investors to access it and use it as a macro tool. And what they showed is, sure enough, they're going to use it the way it is as a hedge. I think if you look, particularly over the last few years, what we've seen is the same pattern. Sometimes on the day of a macro shock, you see Bitcoin fall. I think the studies show that if the NASDAQ falls 2%, Bitcoin tends to fall 2.6%. But if you look over the next week or the next month, at least over the last few years, you've seen Bitcoin recover and then some. So I think these correlations are going to continue to go down. I think it's even happening now. It's just not quite at the reaction trigger. It takes the market a few days to recalibrate. But what we've seen is that once it sort of gets its footing, it finds its way into Bitcoin as the hedge exposure. And, I think we're going to see this decoupling increasingly. It's just a different asset today. It's less of a risk asset. It's more of a hedge asset than it was 5 years ago. It was much riskier. So I think this is a natural evolution of what Bitcoin is. I mean, you've seen the Coinbase ads recently about house prices denominated in Bitcoin and how those prices are going down. And that's compared to everyone else's experience of these dollar-based, fiat-based home prices just going to the moon. I do think that's a significant divergence. I mean, we've talked a lot about, since COVID, the US dollar lost something like 28% of its value and Bitcoin's up 30x. Wow. I don't know, like there it is right there for you. And I think that's going to continue to happen. I do think it's a silent crash. It's a boil the frog element. But I think it's actually happening at an accelerating rate. It's hard to look at those debt charts and the deficit charts and not understand that this is happening at an accelerating rate here in the US, much less around the world. I mean, we have the cleanest dirty shirt in the world from a fiat perspective. So if you think we're experiencing this silent crash here in the US, imagine what it feels like in other markets that are even in worse shape. So I don't think the cycle is going to be as pronounced. In fact, I'm bullish on 2026. The reason for that is I think the two primary drivers of the cycle are the Bitcoin halving and then the economic cycle. It's tended to be aligned with monetary liquidity and with interest rates. That's the economic cycle. And then obviously the Bitcoin halving moves on a 4-year basis. The reason I bring those up is because both of those forces, in my perspective, are weaker now than in previous cycles. The Bitcoin halving gets half as important every time from a supply perspective. That's just sort of math in terms of the amount of supply being cut on a daily basis. And the monetary macro cycle is just no longer on the same 4-year cadence that it was, right? We're already at 4.5% interest. The likely next step on interest rates is down, not up. Monetary liquidity is actually accelerating, not decelerating. So I think it's just in a different place than it was sort of further in the past 4-year cycles. At the same time, we have institutional capital moving in, which is like a 5 to 10-year trend. And I just think that's a more powerful force than these historical drivers of the cycle. So I'm optimistic on 2026. I don't think there's a super cycle though. And I don't think we've repealed volatility by any means. I think the thing to watch from a volatility perspective is how much leverage builds up in the system. Leverage can build up in the futures market. Leverage can build up in the lending market. Leverage can build up through these companies in the debt markets. As we look at it right now, the market's not particularly leveraged. But that doesn't mean it won't be, right? Like if the price dramatically detaches from $100,000 and starts running up, that tends to be pro-cyclical and you get people leveraging into that. And if that happens, then we will absolutely could have another 40 or 50% pullback. I don't think we've repealed those days, unfortunately. I do think we've probably repealed the 70 or 80% pullback days. We're making progress. I think the forces that drove the cycle are reduced versus previous. But I still think this is a volatile asset. You don't get upside returns without volatility. And, I don't know, just think of those as opportunities to accumulate.
What is your outlook here I guess for this cycle? And then also we'll call it this 10-year, gold rush.
So from a 6 to 12 month perspective, the way we look at price is just by looking at supply and demand and thinking about investor behavior. So I can be pretty specific about that. When we look at supply and demand in the Bitcoin market, we see a fundamental mismatch between net new demand and net new supply, by which I mean Bitcoin produces 165,000 Bitcoin a year, right? That's the issuance, and that's the net new supply. And whether you look at ETFs or corporations like MicroStrategy or governments, they're buying hundreds of thousands of Bitcoin, maybe in aggregate a million Bitcoin. So there's this massively more net new demand than there is net new supply. And that means existing holders have to sell. And the reason I bring that up from a short-term price perspective is if you think about Bitcoin's price, since really the ETF launched, it's gone in two phases. It went from 50 to 72, and then it treaded water for 6 months. And then it went from 72 to 100, and it basically has treaded water since then. The reason it stopped at 72 is that people are people, and that was the previous all-time high, and you had to work through people who were willing to sell there. The reason it stopped at 100 is people are people, and some people were willing to sell at 100, right? Like the two sleeping stop loss orders on River are 100 and a million, right? That's just like because people are normal people. I bring all that up because I think this demand is just chewing through the number of people who are willing to sell at $100,000. And if I'm right and it persists, it will eventually exhaust them. And I think in the next 6 to 12 months, it'll move up to the next place people are willing to sell. And I don't honestly know what that number is. I don't think it's 117,321. I think it's probably more likely to be a round number, like 150 or 200 or 200K. And so I think there's going to be upside movement over the next 6, 12 months because there is this excess demand. And our prediction at Bitwise is it'll get to $200,000 this year, but we could be wrong about that. But that's what I think. I think this cycle, which I'd really say lasts through this decade, like until 2020, 30, I think it probably gets to about parity to gold. That's my baseline prediction. So at current prices, that's a little over $1 million a coin. Again, I could be wrong. Like, could go down. It's hugely risky. It's not financial advice. But if you think about, sort of the level of penetration it's gotten to in each cycle, this feels like the right sort of scale of penetration. And I think the supply dynamics are about right for us to get there. So that's our prediction at Bitwise. 200K by this year, $1 million by the end of the decade. We could be too bearish. We could be too bullish. But that's what makes it a prediction.
Welcome to the deep dive. Today, we are really digging into some pretty sharp insights from Matt Hougan. Yeah, his latest commentary, you might have seen it around as the Market Chronicles, episode 36. Our mission here is basically to pull out the key nuggets, the really important stuff about Bitcoin's current market moves, institutional adoption, and its changing role in finance globally. And hey, if you happen to be watching on YouTube, definitely hit that subscribe button. You'll want to stick around for more deep dives like this. Okay, so let's jump right into it. Matt Hougan's view on Bitcoin's price since the ETFs launched. He kind of breaks it down into phases. First, there was that big run up, right, from maybe $50,000 up towards $72,000. Then it sort of tread water for a bit, consolidated. Then came another push from that $72K up to the big $100,000 mark. And now, as he points out, it's been doing that sideways thing again, kind of hovering right around that 100K level. And his reasoning is pretty straightforward, actually. He just says people are people.
It makes sense that you see selling pressure around those old highs, like 72K, and definitely around big run numbers, like 100,000. That's just classic market psychology, isn't it? He even gave that example of sleeping stop loss orders on places like River set right at $100 or even $1 million. It just shows how these numbers become real barriers in the market.
Yeah. And what's fascinating about this current treading water phase is it doesn't really signal weakness, not according to Hougan. Instead, it shows this persistent demand underneath. It's just steadily kind of chewing through the supply, absorbing all the Bitcoin people are willing to sell at that $100,000 level. And if that demand keeps up, which it seems to be doing, well, eventually it just works through those sellers. It absorbs what's on offer. Bitwise actually put some numbers on this, their prediction. They think Bitcoin's likely heading up to the next big sell point, maybe somewhere in the next 6 to 12 months, possibly levels around $150,000, maybe even $200,000. In fact, their specific target, I believe, is 200K by the end of this year, driven by that steady underlying demand.
Okay, so that's the price action, the chewing through resistance. But like you said, this isn't happening in a vacuum. There are these huge underlying shifts going on that Hougan really highlights. Two massive changes for Bitcoin over the last, say, 18 months. The first one is pretty obvious if you've been watching. It's just become way, way easier for traditional investors to get into Bitcoin. We're talking the big players, institutions, wealth managers, thanks to things like the spot ETFs, obviously, and better regulation. It's essentially de-risked the asset for a lot of people who were on the sidelines before. Bitcoin's really moving into the mainstream. And the second shift, which goes hand in hand with the first, is this increasing urgency for those same players to actually get that access. It's not just about can we do it anymore. Now it's driven by, well, pretty serious global worries, rising government debts, deficits everywhere, concerns about potential fiat debasement, basically your dollars, euros, pounds buying less over time, and just a general feeling among smart investors that they need broad exposure to assets that might hedge against these big macro risks.
Right. And that connects directly to what Hougan calls the summer of accumulation. It sounds catchy, but it really describes this deep underlying trend. It's about how capital is fundamentally shifting towards Bitcoin. And we see this playing out in real time. I mean, at Bitwise, we're talking to huge institutional investors, massive wealth platforms, every single day. These guys control literally hundreds of billions, even trillions of dollars. And what's kind of wild is that almost every week, it feels like another big platform switches on Bitcoin access, just opens up another potential $1 trillion of capital that could flow into the asset. It's not a trickle. It feels more like the floodgates opening. The key thing to grasp here, Hougan stresses this, is that this might be a unique phase, sort of one-time window. This is the period where these giant institutional players are making their move into Bitcoin. So for individual investors like you listening, it creates this window, maybe a rapidly closing one to accumulate before that tidal wave of capital fully hits. Hougan's view is pretty clear. Every time Bitcoin kind of ticks sideways like it is now, he sees it as a little gift. More time to stack sats, right? More time to build a position before the price potentially moves much higher, towards what he calls a new normal. It really feels like a limited time opportunity.
Okay, building on that Bitcoin's changing role, let's bring in Mohammed Al-Arian's observation. He's, a major global investor, ex-PIMCO, definitely not some Bitcoin diehard. And he pointed something out, I think, in the FT and on Twitter that really makes you stop and think.
It really does. It forces you to question the whole idea of safe haven assets. Because think about it, for the last, 40 years, during any big crisis, whether it's macro or geopolitical, the automatic safe haven was U.S. Treasuries. Money poured in, yields dropped. That was just the playbook, standard procedure. But Al-Arian's point, the crucial observation, is that in recent crises, that's not happening. Money's not rushing into treasuries like it used to. Instead, he sees it going first into gold. And then, remarkably, often within just a day or two, it flows into Bitcoin. Now, that is an enormous change, a sea change. Really, it suggests the world's idea of a safe haven might be shifting away from government debt towards, hard assets, like gold and now increasingly Bitcoin. It's like that canary in the coal mine, right? A really strong signal for how investment portfolios might need to adjust. Needing exposure to these kinds of assets as a hedge against instability. It's a fundamental rethink of safety.
Yeah, that shift towards a safe haven really underlines its growing role as a macro hedge, too. I remember the tariff tantrum that might have been the first real macro shock where Bitcoin actually showed an inverse correlation to stocks. And it wasn't just random. It happened largely because suddenly you had things like ETFs and options. That made Bitcoin accessible as a genuine macro tool for traditional finance players for the first time. They could actually use it strategically.
Exactly. And if you look at the correlation patterns now, how they're evolving, it backs this up. Sure, studies might show an initial dip on the day of a shock, like the NASDAQ drops 2%, maybe Bitcoin drops 2.6% initially. Okay, but look at what happens over the next week or the next month. Bitcoin has consistently bounced back stronger, recovered, and then some. That points to a real change in its behavior. We're definitely seeing more decoupling from traditional risk assets. It's acting, less like a pure risk-on bet and more like a hedge asset, certainly compared to 5 years ago when it was seen as much riskier, much more tied to tech stocks. It's maturing. You might have seen those recent Coinbase ads. They made the point pretty well, comparing house prices in Bitcoin terms, where they're actually going down, versus house prices in dollars, which look like they're going to the moon. And that ties directly into this silent crash of the dollar, right? Since COVID, the dollar's lost maybe 28% of its purchasing power. Bitcoin, same period, up like 30x. This whole boil the frog thing, this gradual value erosion, it seems to be speeding up. Especially if you look outside the U.S., the situation's often even more stark.
So looking further out then, what about the longer term? Hougan sounds optimistic for 2026, but he's careful too, right? Not necessarily calling a super cycle.
Yeah.
Yeah, he explains that the traditional drivers, the things that used to dictate Bitcoin's cycles, the halving, the big economic liquidity cycles are just, well, weaker now. The halving's impact on supply gets cut in half each time mathematically, so it's less of a driver. And the big macro money cycle, it's not on that predictable 4-year beat anymore. Interest rates look like they'll head down eventually, not up. Liquidity is likely accelerating, so those old predictable patterns are kind of breaking down.
Exactly. And what seems to be replacing them, or at least becoming more dominant, is this longer term, maybe 5 to 10 year trend of institutional money coming in. That fundamental demand seems like a much more powerful force now than those older cycle drivers. It's reshaping the whole market structure. But this is a big... all volatility is not gone. He's very clear on that. Maybe those massive 70%, 80% drawdowns are less likely now with the market being broader, more mature. But could we see 40%, maybe 50% pullbacks? Absolutely. It's still possible, especially if leverage starts building up somewhere in the system, futures, lending, maybe even corporate debt related to Bitcoin. Right now, the market doesn't look overly leveraged, but that could change fast if prices really take off and speculation ramps up. Still, even with that volatility, the perspective should be that these dips are likely opportunities to accumulate, assuming the long-term thesis holds.
Which leads us nicely to that long-term prediction from Bitwise. By the end of the decade, say around 2030, they see Bitcoin reaching parity with gold in terms of total market value. And if you translate that to a price per coin at today's gold prices, it's a little over $1 million per Bitcoin. Now, obviously, that's a prediction. It comes with risk. We absolutely have to say this is not financial advice. But it's certainly a pretty compelling long-term target to think about. So wrapping this up, what's the bottom line for you, the listener?
Well, it seems Bitcoin's market is growing up fast. This institutional wave is real, making it easier for big money to get involved. And its whole identity is shifting, right? From just a volatile, risky thing towards being seen as a real macro hedge, maybe even a global safe haven.
Yeah, and maybe the final thought to leave you with is this. If fiat currencies are silently losing value at an accelerating rate, and if the world's safe haven preference is genuinely shifting from government bonds towards hard assets like gold and Bitcoin, what does that actually imply for how you preserve wealth long term? How might you need to rethink, traditional ways of measuring value in your own financial life? The ground rules seem to be changing. What constitutes a secure store of value is definitely evolving.
It really does paint a picture of huge changes underway in the global economy. Fascinating stuff. Thanks so much for joining us on the deep dive today as we explored these shifts. Keep digging, keep questioning, and we will catch you on the next one.